Well, the central banks of the nations of the world are very important institutions because they stand behind the commercial banking system of each country that they represent. So nowadays in Europe we have, for the European Monetary Union, we have the European Central Bank, which is not affiliated with any particular country. It's actually belongs to all the countries' central banks that are members of the euro area. And that's a very special arrangement. Most countries have their own central bank, which is the ultimate issuer of the national currency. It's just in Europe it's special because we have the European system of central banks, which, if you want to call it the euro system, basically jointly owns the European Central Bank, and at the same time it gives a joint authorization for the European Central Bank to conduct monetary policy, which means set the interest rates, set reserve requirements for the banking system, determine other rules that apply to the behavior of banks. It's important to remember that the central bank doesn't control the entire money supply. It really only controls the currency and the unit of measure that commercial banks in a country's economy issue deposits, and that's really what the money is in a country. So in the European Monetary Union, commercial banks issue deposits. People have deposits denominated in euros, and they can also borrow money based in euros. So ultimately that's the way the European Central Bank, the central bank of the European monetary system, exerts control over the monetary conditions. Why are they so important? Well, if you think about it, we're using money in our day-to-day transactions. Even when we use a credit card, we're debiting ultimately our bank account or taking up a loan with a credit card company to pay for something that we want to have. And the recipient, the vendor, would like to have some money in return for that sale. And that's all managed in the background by the banking system. And we don't see cash passing hands between those transacting parties. We actually see bank accounts or claims on commercial banks. So the commercial banks are ultimately the source of the money supply. Central bank is kind of a backstop or a guarantor or the bank of the banking system in a country or a currency area. And that's important to remember because it's a singular player. It has lots of power and lots of authority, and makes lots of important decisions that affect our lives. One of the decisions that affects our lives, that affects our lives, is the setting of the interest rate. And there's been a lot of controversy in Europe recently about the level of interest rates that the European Central Bank charges on commercial banks that want to borrow money from the European Central Bank. And that's how money ultimately gets created. The banks that make those loans have to pay an interest rate to the central bank in order to make the loan to you. And that rate obviously is important for the bank's profitability. And in recent years it's been very, very low, but it's also the case that a lot of commercial banks don't know what to do with their money. They have lots of depositors that have put money in their bank, and they bring that bank to the money to the central bank and deposit it there. And for many years there was an interest rate that these commercial banks could receive for their deposits at the European Central Bank. And in recent years, this interest rate has gone to zero and has crossed the magic line. It's actually now negative, which means that the European Central Bank actually charges banks. It doesn't pay banks for the deposits they receive. So this penalty rate, if you like, is a way of stimulating private banks, commercial banks, to make more loans, but it's also putting these banks in a bit of a profitability squeeze. So there's a lot of controversy over the way central banks behave, and of course if they raised interest rates right now, that would be wonderful if you have a bank deposit that pays interest, and maybe that interest rate would show up in your own interest rate, but ultimately that may have some bad effects on the economy, and that's something that policymakers are concerned with.